Good evening, and welcome to the Crypto Overnighter. I'm Nikodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on a Saturday, April 29th, 2023. And here we go again. Another crypto-friendly bank in the crosshairs. The Federal Deposit Insurance Corporation issued a consent order to Cross River Bank. And as you may have guessed by its presence on this show, Cross River Bank is a crypto-friendly bank. The FDIC issued them a consent order for engaging in, quote, unsafe or unsound banking practices related to its compliance with fair lending laws and regulations. This order requires Cross River to improve its internal controls, information systems, and credit underwriting practices. Now, Cross River did not admit or deny wrongdoing. It did say that it has already made significant improvements to its compliance program. They said that they're dedicated to partnering with the fintech community, that they're a, quote, model for transparent, compliant, fair, and reasonable lending. The FDIC's order comes amidst increased scrutiny of crypto-friendly banks. Back in March, the New York Department of Financial Services seized Signature Bank. And Signature Bank, of course, was another crypto-friendly bank. Again, allegedly it found that the bank had engaged in unsafe or unsound banking practices. This instability in the banking sector raises concerns about the future of crypto lending. Some experts have warned that the collapse of crypto-friendly banks could ripple effect on the broader crypto market. Others have said that the FDIC's order to Cross River Bank is a sign. Regulators are taking steps to protect consumers and to ensure the stability of the banking system. Now, we don't know how the FDIC's order will impact the crypto lending industry, but it sure looks like another step in terms of governmental overreach in trying to stomp out crypto. Regulators are taking a closer look at crypto-friendly banks, and they're not doing it out of a place of good faith. On Friday, the FDIC said that Signature Bank fell apart because of mismanagement by its officers, as well as contagion effects after the collapse of Silicon Valley Bank and the wind down of Silvergate Bank. All three tech and crypto-friendly banks, by the way. What a coincidence. The FDIC said Signature Bank relied heavily on uninsured deposits, that they didn't have strong liquidity risk management practices, and that they maintained poor risk management in general. This was exacerbated by a bank run spurred by the collapse of other banks, at least according to the report. And of course, the fact that the bank was serving the crypto industry was also cited as a major risk. They said, quote, additionally, SBNY failed to understand the risks of its association with and reliance on crypto industry deposits or its vulnerability to contagion from crypto industry turmoil that occurred in late 2022 and into 2023. The FDIC has been reviewing its oversight of Signature Bank ever since the New York Department of Financial Services seized the bank back in March. So by now, it's obvious that Signature was shut down specifically for serving crypto customers. Regardless, New York Department of Financial Services Superintendent Adrian Harris has repeatedly said that the bank had other issues. This report comes on the same day that the Federal Reserve and the Government Accountability Office published the results from their own reviews of Silicon Valley Bank and Signature. Like the FDIC, the Federal Reserve attributed SVB's collapse to serial mismanagement made worse by unaccounted for risks. In SVB's case, the risks came from interest rate hikes and liquidity issues. The GAO noted that Signature had, quote, reduced its exposure to deposits from the crypto industry over the course of the year up to its collapse. They said, quote, Silicon Valley Bank was affected by rising interest rates and Signature Bank had exposure to digital assets industry. The banks failed to adequately manage the risks from their deposits. Now, all three reports point to a lack of action from federal regulators as a contributing factor. They're saying the bank's supervisors could have acted sooner to request more information, or otherwise manage the banks and their risks. Bank regulators in the United States have kind of changed their story a little bit over the high-profile bank failures back in March. The banks closed within days of each other, with California regulators shuttering SVB on March 10th. Then, The NYDFS moved against Signature Bank on March 12th. Silvergate Bank had already gone the way of all flesh. They announced their voluntary liquidation on March 8th. This set off the runs on the banks. The string of failures set off shockwaves serious enough that U.S. President Joe Biden jumped in and tweeted a response. The Fed review started with findings that had been noted by commentators, specifically that SVB's management had failed to manage its risks. Their supervisors, quote, did not fully appreciate the extent of the vulnerabilities of the bank as it grew in size and complexity. This was even though they felt that SVB's foundational problems were widespread and well known. And the supervisors failed to act quickly on the vulnerabilities that they did identify. Annual CAMELS exams uncovered risk-related deficiencies in 2021 and 2022. That said, changes in the supervisory team and the bank's rapid growth got in the way of handling them. Quote, the supervisory approach at Silicon Valley Bank was too deliberative and focused on the continued accumulation of supporting evidence in a consensus-driven environment. Regulatory easing due to the passage of the Economic Growth, Regulatory Relief, and Consumer Protection Act in 2019 led to a tailoring approach to regulating many large banks. The supervisory policy was changed at the same time. It placed greater emphasis on due process, which slowed down regulatory action according to the report. The Fed made a concession, however, quote, while higher supervisory and regulatory requirements may not have prevented the firm's failure, they could have mitigated its impact. The NYDFS found that Signature Bank had also experienced rapid growth in the years immediately before its closure. It was like SVB in that it had a high proportion of deposits that were not insured by the FDIC. They said, quote, the bank's growth outpaced the development of its risk control framework. Now, this whole thing from Cross River Bank on down seems to be another casualty of Operation Choke Point 2.0. Operation Choke Point 2.0 is what a whole lot of people call an initiative by the U.S. government to crack down on cryptocurrency. Choke Point 2.0 is dangerous for the country. It's a horribly misguided attempt to stifle innovation and economic growth. Cryptocurrency is a new and disruptive technology. It's a technology that has the potential to revolutionize the way we think about money. It's a decentralized peer-to-peer system that takes out the need for a third party, such as a bank. That makes it a powerful tool for financial inclusion and empowerment. That is, if the government doesn't foolishly destroy it, all under the lie of protecting us from our own selves, I would add. Choke Point 2.0 attempts to turn back the clock on innovation. It is a clear example of government overreach and bureaucracy at its worst. The government shouldn't be in the business of picking winners and losers in the marketplace. It should let the free market decide what technologies succeed and which ones fail. Because the government makes stupid decisions like letting Taiwan take the lead on making silicon chips. How much money and how much innovation did that cost us? All in the name of protecting us. Folks, we need to stand up to Operation Choke Point 2.0. We need to continue to defend our right to innovate and use new technologies. This is a fight for the future of our economy and our freedom. Thank you for listening tonight. And if you're enjoying the Crypto Overnighter, I'm going to ask you to like, follow, and subscribe to the podcast. It makes a big difference in introducing new people to the show. A group of lawmakers plans to hold a series of hearings in May. These hearings will address the regulation of digital assets in the United States. The hearings will be led by the House Financial Services Committee Chairman Patrick McHenry. He will be joined by Representatives Glenn Thompson, French Hill, and Dusty Johnson. Now, they put out a joint statement. They said that they want to strike a balance between protecting consumers and fostering innovation in the crypto industry. Quote, we must strike the appropriate balance to protect consumers without stifling responsible innovation. The hearings are expected to focus on a number of issues. Some topics are the regulation of stablecoins, the role of the SEC and the CFTC, as well as the taxation of crypto assets. They said that they plan to introduce legislation in coming months to provide regulatory clarity to the crypto sector. And speaking of taxes, A new study by researchers at Indiana University and the University of Maine is calling for a new tax framework for cryptocurrency losses. This study was published in the journal Tax Policy and the Economy. It argues that the current tax treatment of crypto losses is unfair. They say that it encourages investors to take on too much risk. At present, investors can deduct crypto losses from their other crypto gains. However, researchers argue that this encourages investors to invest in crypto even when it's not a good idea. Quote, "This risk sharing can encourage investment in cryptocurrency and away from other investment activities of value economic significance." The researchers propose a new tax framework, one that would allow investors to deduct crypto losses only from their crypto gains. They argue that this would discourage investors from taking on too much risk and help stabilize the crypto market. The study's findings will be likely welcomed by many crypto investors, who have been frustrated by the current tax treatment of crypto losses. However, whether the government will adopt the researchers' proposed tax framework is unclear. The European Central Bank is working on a digital euro. Even so, there are concerns about how it will affect the banking industry and its consumers. The ECB has released a new report on the digital euro. In this report, they outline 3 use cases: person-to-person payments, consumer-to-business payments, and payments to or by the government. Now, some banks are concerned. They're worried that the digital euro could threaten their business models. Jérôme Grevet is the deputy CEO of French bank Crédit Agricole. He said the digital euro could, quote, "compete with their collection activity and disrupt their financing capacity." Still others are concerned about the impact of the digital euro on consumers. Burkhard Bols is a member of the executive board at Deutsche Bundesbank, and he said that the ECB should avoid extending its footprint in the ecosystem too much, specifically by having the private sector run the distribution of their digital euro. The bank said that it's still in the early stages of planning for the digital euro. They said that they will take into account the concerns of both banks and consumers. In other news, MasterCard has launched a new Web3 solution to enhance user verification standards and to reduce the opportunities for bad actors in the digital asset space. The solution is called MasterCard Crypto Credential. It will issue users a unique identifier. Now, this identifier can be used to verify their identity on Web3 platforms. MasterCard said that this solution will help reduce fraud. It will also make it easier for consumers to transact in digital assets. Now, MasterCard is not the only company working on solutions to address the challenges of Web3. Other companies are also developing products and services to make it easier for consumers to use digital assets. As we watch the Web3 ecosystem grow, it becomes clear there is a need for solutions that address security and fraud challenges. MasterCard is one such example of a solution designed to address these challenges. And finally, our cover story for the night. Remember Alex Pertsev? He's the developer at Tornado Cash who was arrested in August of 2022. It appears that he was released from prison. Apparently, he's now back on Twitter. Now, Pertsev was arrested in connection with the U.S. government's sanctioning of Tornado Cash. His arrest sparked criticism that he should not be penalized for developing open source code. It also raised questions about the future of law enforcement actions against distributed protocols like Tornado Cash, protocols where the creators no longer have control. In other news, Tesla CEO Elon Musk has announced that creators on Twitter can now monetize their content using this new subscriptions feature. This feature allows Twitter users to charge their followers a monthly fee to access exclusive content. Twitter will allow creators to keep 97% of the revenue up to $50,000 in lifetime earnings, after which the revenue split will be dropped to 80% for creators. This revenue share will only begin after the users earn the minimum threshold of $50. The subscription services are non-refundable, even if the creator's Twitter account gets suspended for any reason. Musk has also reportedly purchased nearly 10,000 graphics processing units to build AI tools that will detect and deter misinformation on Twitter, which is interesting, given his recent warning against AI development due to societal concerns. And I'm kind of with him on that last. I don't worry so much that AI is going to nuke us out of existence or enslave us or anything like that. However, many of the societal issues AI will bring, we're really not even ready to talk about. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, maybe a review. And in the meantime, we'll see you tomorrow night.